What if I told you that the United States produces just 15% of the world's economic output, but it makes up a staggering 50% of the entire global stock market?
Yeah. I mean, it is just a massive disparity when you really look at the numbers.
Right. It's crazy.
Half of the world's equity wealth is basically concentrated in a country that represents, less than a sixth of its actual GDP.
Welcome to the deep dive, by the way, because that single statistic, it completely changes how you should be looking at your own retirement accounts.
Absolutely.
Today, we're pulling from this really fascinating Wired Q&A session with Duke University finance professor Cam Harvey.
And the mission here is really to just cut through the absolute avalanche of financial advice you see on social media every single day.
Oh, it's everywhere. Just a constant wall of noise.
Exactly. We want to extract the actual foundational mechanics of how smart investing works, like how it actually works.
So we're going to look at how to build a portfolio that can actually survive market chaos. And we'll analyze the current AI boom to see if it's just a giant house of cards.
Right. And we are going to break down the actual math of why the odds are so brutally stacked against the everyday day trader.
Okay, let's unpack this. Because I know if you're listening and you're looking at your 401k right now, it's almost certainly heavily tilted toward the U.S.
Very likely, yeah.
But before we can even talk about how to rebalance that or, what you should even be buying, we really have to look at the psychology of losing.
Which is huge.
We have to understand why everyday investors just consistently set their own money on fire.
And honestly, it comes down to a behavior that everyone knows is a bad idea. I mean, we all know it, yet almost everyone falls victim to it.
Buying high and selling low.
Exactly.
Yeah.
We are fundamentally wired to just follow the herd. Like when an asset is sitting quietly at a reasonable price, nobody cares.
Right, it's boring.
But when that price skyrockets, suddenly it generates headlines. It generates this massive fear of missing out.
FOMO is real.
Oh, very real. People only want to buy in after an asset has attained this incredibly lofty, totally unsustainable valuation.
Right, so you see your neighbor suddenly buying a boat because they got in on some tech stock, and you think, well, I need to get in on that.
Yep.
So you buy at the absolute peak, the stock inevitably corrects, you panic, and then boom, you sell at a loss.
Which is the exact opposite of what you're supposed to do.
But let's actually demystify what a lofty valuation even means. Like, how do we objectively know if a stock is just too expensive?
Well, this brings us to the PE ratio, right? The price-to-earnings ratio.
Okay, break that down for us.
It's basically the most crucial metric for a foundation in investing. So the P is simply the stock's current price.
Makes sense?
And the E is the earnings, the actual profit the company makes per share. So you just divide the price by the earning.
Okay, simple math.
Right. But when that resulting number is really high, especially compared to the company's own history or the broader market, it means you are paying a massive premium.
Just to get a slice of whatever profit they generate.
Exactly. You're overpaying for every dollar of actual profit.
Is the PE ratio basically like checking the price per square foot of a house? Like, if it's too high, you're just massively overpaying for the neighborhood.
That's a great way to think about it, yeah.
Let me try to put another real-world spin on this. Imagine you're looking to buy a successful local bakery.
Okay, I like bakeries.
Right. So the owner says the bakery generates $10,000 a year in pure profit. That's your earnings.
Right.
But the owner wants to sell you the business for $1 million. That's the price.
Wow, okay.
So that would give you a PE ratio of 100. You're paying 100 times the annual earnings. It would literally take you a century just to break even.
That is a brilliant way to frame it. I mean, at a PE of 100, that bakery is insanely expensive. It's wildly overvalued.
Nobody would buy that.
Exactly. And in the stock market, when a PE is that high, there's a very strong mathematical probability that the price will eventually revert to the mean.
It'll just drop back down to reality.
It drops back down to a normal historical valuation, yes.
But wait, if I look at the market right now, the PE ratio for the S&P 500 as a whole is historically very high. A very expensive bakery right now.
It is, yeah.
So if I'm listening to this, shouldn't I just, I don't know, take my cash, put it under my mattress, and wait for the inevitable crash before I invest?
I hear that logic constantly, but it is a massive trap.
Really? It seems logical.
It does, but sitting in cash waiting for a crash is exactly how retail investors miss out on the market's long-term wealth generation.
Yeah.
The S&P 500 has a historical long-term average return of about 7% a year.
Which is roughly a 5% real return plus about 2% to compensate for inflation.
Yes, exactly. But here is the catch. You only capture that 7% average if you stay in the market through the absolute worst days.
Because it's not a smooth ride.
Not at all.
Yeah.
The stock market doesn't just hand you a neat 7% every January. It's violent.
Yeah, it might drop 20% one year and then surge 25% the next.
Right, and if you pull your money out the second you get scared, waiting for the dust to settle, you will almost certainly miss the sudden, massive surges.
And those surges are what make up the bulk of that 7% average.
Exactly.
This raises an important question then. If it's not about avoiding the drawdowns, it's about building a portfolio that lets you stomach them without panicking, right?
That's the key.
Which brings us back to that wild statistic from the top of the show. If we shouldn't try to time the market, how do we actually structure our money?
Right. Let's get into the mechanics.
Say a listener has $20,000 to invest today. Where does it actually go?
Well, it goes to the 50-50 rule.
Okay, that's that.
We mentioned earlier that the U.S. is 15% of global GDP, but 50% of the world's stock value.
Right, which still blows my mind.
It is crazy. But this extreme dominance means the U.S. market is incredibly concentrated.
And if you are entirely invested in the U.S., which, let's be honest, most American retail investors are, you are taking on a hidden risk.
A massive geographic risk, yeah.
I can hear listeners getting anxious about their all-U.S. index funds right now.
Well, you're not saying the U.S. economy is doomed.
No. But you're saying past performance doesn't guarantee future results, and ignoring the other 85% of the world's economy is just bad math.
Exactly. The expert advice from Professor Harvey is a strict 50-50 split.
So half and half.
Put 50% of your equity investments in the U.S. and 50% in international stocks.
Just using like broad, low-cost exchange-traded funds, like ETFs.
Yep, ETFs that cover both developed and emerging markets.
So we take the bulk of that hypothetical $20,000, we put it in these boring, globally diversified index funds.
Right, and you put a little bit into a money market fund for a safe yield.
Okay, but the sources suggest keeping a specific chunk of it out, like 5 and 10%, the 10% rule.
Yeah, this is where we account for human nature. We hold out up to 10% of the portfolio to pick individual stocks.
See, here's where it gets really interesting.
Why is that?
Because we literally just spent all this time establishing that picking individual stocks is a terrible idea for most people.
We did, yeah.
But this strategy is basically like a financial diet. 90% of your money is your responsible, boring vegetables, your diversified index funds.
Right.
But that 10% is your dessert. It's your sandbox.
I love that analogy. It's a sandbox, but it actually serves a really vital educational purpose.
How so?
If all your money is locked away in an index fund you never look at, you disconnect from how the economy actually works.
You just set it and forget it.
Right. But when you carve out 10% and put your own actual cash on the line in specific companies, suddenly you care.
Oh, you definitely care when it's your money.
Exactly. You start learning how to read valuation metrics. You start paying attention to the news.
But how do you actually research those companies? You can't just, pick a stock because you think the logo on their products looks cool.
No, definitely not. The sources outline a very deliberate process for this.
Okay, what's step one?
First, you read the 10K filings. Those are the official annual reports submitted to the SEC.
Okay.
Sounds a bit dry, but sure. You also look at analyst coverage. But the absolutely most revealing step is the quarterly earnings call.
The phone call.
Yes, but specifically the unscripted Q&A section at the very end.
Wait, that distinction is critical because a company's 10K report is highly manicured.
Oh, incredibly. It has been reviewed by armies of corporate lawyers and PR teams.
Right. Every single word is calculated to minimize liability and just project absolute stability.
Exactly.
But aren't CEOs just PR machines anyway? Even on a call, aren't they basically just reading from a script?
For the first half of the call, yes, it's totally scripted.
Right.
But the second half is an open Q&A with financial analysts, and those analysts are actively looking for weaknesses.
They want to find the holes.
Yeah. The CEO and the CFO have to answer complex, combative questions in real time, completely without their legal team holding their hands.
So if you listen closely, you hear the hesitations.
You hear the hesitations, you hear the defensive tones, or conversely, you hear genuine, unscripted confidence.
Wow. So that Q&A section gives you the actual underlying reality of a company's health.
It really does. It's invaluable.
Okay, so you've done the research, you've suffered through the agonizingly dry earnings calls, and you're ready to place your trades.
Yep.
The sources actually give specific advice on brokerages, too, based on where you are in life.
They do. If you're a younger investor or just starting out, you should absolutely use the low-cost apps.
Like Robinhood or Schwab.
Exactly. You want frictionless access and basically zero commissions.
Makes sense.
Yeah.
But as you accumulate wealth, your needs shift, right?
Definitely. Older, more mature investors shouldn't be afraid to migrate to premium brokerages.
Even if they charge a fee.
Yeah, they might charge a 0.5% or even a 1% annual fee.
Which sounds completely counterintuitive. I mean, 1% of a large portfolio is a massive amount of money to hand over every year just for the privilege of holding your stocks.
It is, if all they did was hold your stocks.
Right.
But at that level, you aren't really paying for trades. You are paying for a massive suite of professional services.
Like what?
Estate planning, complex tax strategy, legal structuring for inheritance.
Ah, okay. The complicated stuff.
Exactly. Once your financial picture becomes that complicated, the value of those services vastly outweighs the percentage fee.
All right, so you've got your 50-50 global split. You've got your 10% sandbox funded on your app.
Ready to go.
What is the first thing a retail investor usually does?
Oh, they look at the loudest, flashiest assets dominating the news cycle.
Always. So let's talk about the big three: gold, crypto, and artificial intelligence.
Perfect.
Let's start with gold. People treat it as the ultimate mattress stuffer, right? A safe haven when the world is ending.
That is the narrative that has survived for millennia, literally.
Duh.
But if you actually look at the data, it harbors a massive secret. Gold is incredibly volatile.
Really?
Yes. In fact, historically, the price of gold swings almost exactly as wildly as the S&P 500 itself.
That is such a counterintuitive insight. Why does a shiny rock swing so wildly if it's supposed to be our safe harbor?
Well, because gold doesn't produce anything. It's not a bakery generating $10,000 in profit.
Right, doesn't pay a dividend.
Exactly. Its entire value is dictated purely by human sentiment. It's only worth what someone else is willing to pay for it tomorrow.
And human sentiment, especially during times of economic fear, is violently unstable.
Which is why the price whipsaws all over the place.
Which is actually a perfect pivot to the ultimate sentiment-driven asset, crypto.
Oh, crypto. Yes.
The sources are actually very pragmatic here. They don't dismiss it entirely, but they draw a hard line between unbacked and backed crypto.
That's a crucial distinction. Unbacked is your Bitcoin or your meme coins.
Assets that only have value because the internet collectively agrees they do.
Exactly. Whereas backed crypto would be a stablecoin pegged directly to a US dollar, or, a token mathematically tied to physical gold in a vault.
And regardless of which you choose, the rule they give is strict.
Very strict. Limit your total crypto exposure to between 2% and 4% of your entire portfolio.
Wow, so it shouldn't even take up your whole 10% sandbox.
Not even close.
And if you decide to play with meme coins, those coins based on dog pictures that shoot up 1,000% overnight.
The sources are blunt about those. You have to understand that meme coins are 20 to 100 times more volatile than the stock market.
That's just gambling.
You are entering a casino where the house has stacked the deck. You must be emotionally and financially prepared for that investment to go to absolute zero.
Because it's pure speculation, totally divorced from fundamental value.
100%.
Which brings us to the real elephant in the room right now, the AI bubble.
Yeah, this is the big one.
We are watching tech companies add billions of dollars to their valuations in a matter of hours simply by mentioning AI on an earnings call.
Just saying the letters A and I.
Exactly. And a lot of listeners lived through the late 90s. They remember pets.com. They remember the NASDAQ totally crashing.
Right.
Is this 1999 all over again?
It's the most common question in finance right now, honestly.
And what's the verdict?
Well, Professor Harvey makes a compelling case that today's AI boom is fundamentally, structurally different from the dot-com bubble.
Okay, let's break this down organically. Because in the 90s, you had companies going public and hitting massive valuations based entirely on a cool website and the vague promise of future revenue.
They were just burning cash, no actual profit.
But if you look at the companies leading the AI charge today, Microsoft, Google, NVIDIA, they are already printing money.
That is the first major distinction. The leaders of this boom are already massively historically profitable.
Right.
They have real staggering earnings to actually support their valuations.
Okay, so strong balance sheets. But beyond the money, You have to look at the nature of the technology itself, right?
Yes. The internet in 1999 was largely a communication and distribution tool. It made ordering a book faster.
Sure.
But AI is fundamentally different. AI is creative, and it solves highly complex problems autonomously.
So it's not just a tool for tech companies. It has universal application.
Exactly.
Like a logistics company can use AI to instantly reroute thousands of trucks around a storm.
Yep.
Or a pharmaceutical company can use AI to simulate millions of protein solds to discover a new drug in days instead of decades.
It touches every single sector simultaneously.
What's fascinating here is how that universal application drives a third phenomenon.
Right, which is perhaps the most crucial difference from 1999, self-disruption.
I love this concept. Let me see if I have this right.
Go for it.
Self-disruption is like, okay, imagine a highly successful, really expensive local restaurant. They are packed every night, making great margins. But the owners realize food trucks are the future. So instead of fighting it, they open a cheaper, highly efficient food truck right across the street.
Intentionally stealing their own dine-in customers.
Exactly, just to ensure a competitor doesn't do it first.
That is exactly the dynamic. Today's tech giants are entirely willing to cannibalize their own wildly profitable business models to stay ahead of the curve.
It's brilliant, honestly.
The sources point to Tesla as a prime example of this.
Because people value Tesla as a car company.
Right, but strategically, they are a robotics and AI company.
They are willing to completely disrupt their own traditional automotive sales if it means dominating the future of autonomous robotics.
They aren't waiting to be disrupted by a startup in a garage. They are doing it to themselves.
So you have massive profitability, universal application, and aggressive self-disruption. That creates a much sturdier foundation than we had in 1999.
Much sturdier.
But seeing all this explosive growth in AI naturally tempts people to try and day trade the daily swing.
Of course it does.
To open an app, buy at 10 a.m., and sell at 2 p.m. And the sources warn that this is a catastrophic idea.
It really is. It's the David versus Goliath problem.
Why is it so bad?
This is where we need to talk about the brutal reality of market mechanics.
Okay.
When you day trade on your phone, you might feel like you're playing a solitary game, like it's just you and the market.
Yeah, that's how it feels.
But you are actively competing against institutional supercomputers. You're trading against hedge funds and high-frequency trading firms.
Wait, let me push back on that for a second.
Sure.
A few years ago, we saw massive news stories about retail investors on Reddit, regular people banding together and absolutely crushing hedge funds with meme stocks.
You stop, yeah.
Right. They forced billion-dollar funds into massive losses. Doesn't that prove David can actually beat Goliath?
It proves David can land a lucky shot, but he can't win a war of attrition.
Interesting.
What happened there was a short squeeze, a highly specific, totally anomalous event. The Reddit traders found a vulnerability and exploited it brilliantly.
But it wasn't a replicable long-term investment strategy.
Not at all. Over thousands of trades across years, the structural advantages of a hedge fund will always grind down a retail trader.
Always.
Always.
And to understand why, we really have to look at the literal mechanics of how a hedge fund operates.
Right.
They don't just buy stocks and hope they go up.
Yeah.
They use a long-short mechanism.
Yes.
Can you explain mechanically how a short actually works? Because honestly, it sounds like black magic to most people.
It does sound like magic, but it's just a contract. When a hedge fund shorts a stock, they believe the price is going to drop.
Okay.
So they borrow shares of that stock from someone else and immediately sell them at today's high price.
Let's say $100.
Right. They now have $100 in cash, but they owe someone a share.
Okay, I follow.
If they are right and the stock drops to $70, they buy a share back at $70, return it to the original owner, and pocket that $30 difference.
So they literally profit from destruction. Now, apply that to a whole portfolio. If I buy an S&P 500 index fund and the market crashes 20%, my retirement account loses 20%.
You take the full hit.
Right. But the hedge fund has a long side stocks they own and a short side stocks they bet against.
Correct. The market crashes 20%, the hedge fund's long stocks drop, and they lose 20% there.
Okay, so they're losing money too.
But on their short side, let's say those specific failing companies drop by 30%.
Oh, wow.
The fund actually makes a 30% profit on those shorts.
So they use 20 on one side, gain 30 on the other, resulting in an overall 10% gain.
Exactly.
The market is burning to the ground, and they are mathematically shielded still turning a profit. That is terrifying.
It's an incredible structural shield, and they combine that strategy with high-frequency trading.
Which is what, exactly?
They literally have servers located physically closer to the exchange, so their data travels fractions of a microsecond faster than yours.
If we connect this to the bigger picture, day trading against them is basically like showing up to a Formula One race on a bicycle.
That is a perfect analogy. You just can't compete.
And they lock down the smartest minds on Earth to build these systems using stock options. We always hear about tech bros getting rich on options. How does that actually secure talent?
It perfectly aligns the employee's greed with the company's growth.
Okay, give me an example.
A hedge fund or tech firm will give a brilliant AI engineer the option to buy company stock 5 years from now at today's price.
Let's say $100 again.
Right. Over 5 years, that engineer works 80-hour weeks, builds an incredible predictive algorithm, and the stock soars to $1,000.
Oh, I see.
They exercise their option, buy the stock for $100, and immediately capture $900 of pure profit per share.
It's golden handcuffs. They're never going to leave.
Never.
So regular retail traders realize they can't outprogram these guys. They can't hedge like them, so they look for a shortcut.
They watch TV pundits.
Exactly. They scour internet forums for mad money-style tips, wondering if acting on that advice is somehow insider trading.
Which is a complete misunderstanding of financial law.
Really?
Trading on information from a TV show or a public forum is perfectly legal because the information is public.
But it's still dangerous.
Incredibly dangerous. If a famous pundit hypes up a tiny company on television, millions of people might buy it the next morning.
Artificially pumping the price up.
Yes, right before it crashes back down.
You're just being manipulated by the herd again.
Exactly. Real insider trading is entirely different. It relies on non-public material information.
Like knowing the secret results of a pharmaceutical trial before it's announced.
Yes, or seeing a merger document before it's signed. Trading on that is a federal crime.
Okay, so what does this all mean for the listener who wants to day trade on their phone?
It means you are sitting down at a poker table against a casino that has an infinite bankroll.
And teams of mathematicians whispering in their ear.
Right, and the ability to mathematically shield themselves from losing hands. You are playing a completely different game.
Let's summarize the laboratory findings for you today.
Good idea.
Dodge the instinct to buy high and sell low by actually looking at the math. The PE ratio.
Yes.
Rebalance your portfolio using the 50-50 international rule to protect against total reliance on the U.S. market.
Crucial step.
Have fun with your 10% sandbox by listening to those unscripted earnings calls, but recognize that day trading against institutional supercomputers is just a losing battle.
It all comes down to knowing where you have an edge and where you absolutely don't.
Right. But there's one final really frustrating reality from our sources that we want to leave you with today.
Yeah, a structural gatekeeper that has nothing to do with your intelligence or your computing power.
We need to talk about private equity.
A VIP room of wealth creation.
Exactly. Professor Harvey points out this glaring contradiction in the American financial system.
There are incredibly exciting private companies out there driving massive innovation. Think of companies like SpaceX.
Huge potential.
But as an everyday citizen, you are legally barred from buying equity in them before they go public.
Wait, really? Why?
To invest, the SEC requires you to be a qualified investor. And in the U.S., being qualified is almost entirely dictated by your net worth or your annual income.
So it's just about how rich you already are.
Pretty much.
He shares this profound example in the source material. Imagine a high school biology teacher.
Okay.
They didn't go to Wall Street. They chose to teach.
Huh.
But they study biotech passionately as a hobby. They read the clinical papers. They deeply understand the science.
They are a genuine, undeniable expert in the field.
Exactly. But if they spot a revolutionary private biotech startup and want to invest their savings, they are legally forbidden.
Despite their deep, specialized knowledge, the government says they aren't qualified.
Simply because their teacher's salary doesn't cross a magical wealth threshold.
It really brings everything full circle.
We spend this entire deep dive telling you to do your research, to study the fundamentals, to be disciplined and act like a scientist in a laboratory.
Yet at the very highest levels of explosive early-stage wealth creation, the laboratory doors are just padlocked.
So we leave you with this final thought to ponder. If we are constantly told that thorough research, patience, and financial literacy are the ultimate keys to successful investing.
Why is access to the market's most explosive wealth-building opportunities gate-kept by the size of your current bank account rather than the depth of your actual knowledge?
It really seems the game is still rigged, just in ways the flashing casino lights don't let you see.